Hello, Steve Lentz here with Discover Options. Welcome to this edition of various timing reports for advanced options traders. This will be for Friday, July 28th, getting ready for Monday's open on July 31st, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome, everyone. We will cover 3 reports today for advanced options traders: a Condor butterfly timing report, for those of you that like to sell premium from a market neutral perspective. For those of you that like to lean your premium selling a little bit bullish, we have the bull put spread timing report for the S&P 500, and then also for those just wanting a directional likelihood analysis from a statistical perspective, we have the directional likelihood report as well. Before we get going, I'd encourage you to, if you haven't already done so, please click on the link, give us your information. We'll get you this free ebook out to you, co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. Also, we would appreciate it if you could subscribe by clicking on the button. That way you will get alerted every time we come out with a new recording on this channel. The current market condition is defined in 3 ways: price action, trend, and then the stochastics analysis. In terms of price action, Thursday was an outside day, Friday was an inside day, and that's kind of an unusual price action. And then it occurred when we're above the 50-day simple moving average at the same time that the 15-3 stochastic is very high and coming down. All that makes for a very rare market condition defined in that manner. It's only occurred maybe 24, 25 times since January of 2000. Is it statistically relevant? Well, perhaps not for some, but it's better than nothing. So we're going to take those 24, 25 occurrences and just see what the market did in the context of these 3 reports, okay? So first, let's go to the Condor butterfly timing report. This report answers the question, is now a good time to implement a condor or a butterfly position in terms of advanced option strategies and selling premium from a market neutral perspective? So here's the report as follows. Since January of 2000, there have been over 4,400 daily closes of the S&P 500. Now, of those 4,400, 46 to be exact, of those, 65.5% have been favorable bars for selling premium, where the actual subsequent 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, 65.5%, that's the baseline. Now, also during that time, as I just stated, the current condition that we just went over has occurred just 24 times. Outside bar followed by an inside bar, trending up, but the stochastic is coming down from a high position. Now, of those 24 times occurrences, 62.5% of the bars have been similarly favorable for option premium selling. Now, that implies a premium selling edge of minus 3%. 65.5%, 62.5%, there's a 3-point difference there. So statistically, it's technically more likely than usual that the current market condition will end up being unfavorable for market neutral option premium selling. Now look, does that mean that if you put on one of these strategies you're going to lose money? Well, no. No, I mean, you'll still have a 62.5% chance that the markets are going to be fairly calm relative to the premium that you're collecting. Okay, but that's less than what the benchmark is if you just flipped a coin in the S&P 500 market. Okay, and you might be very confident in your adjustment approach and everything, and we certainly teach that here at Discover Options, ways for you to adjust your market neutral positions. But nevertheless, that's the report, and that's the condition that we have currently as we are looking at the close on Friday. All right, let's go to the next report, and that's for those of us that like to lean things a bit bullish. Perhaps you're leaning your condors bullish. Perhaps you're doing those out-of-the-money put butterflies in a broken wing fashion and leaning it a little bullish. This report answers the question, is now a good time to sell out-of-the-money put premium 30 days out, a standard deviation away? out of the money put premium 30 days out a standard deviation away. So here's the report. So since January, as we've mentioned, of 2000, there have been 4,446 daily closes of the SPX. Now, of those, 82.9% have been favorable bars for selling that out of the money put premium, where the actual 21 bar downside movement was less than the SIBO skew adjusted implied movement to the downside. Now, so that's the benchmark, 82.9%. You could flip a coin, and roughly 17% of the time, the market would go down a full standard deviation within 21 days, 21 trading days. Okay, the rest of the time, okay, was almost 83%. The market was fine. It did not go down that much. Okay, pretty good statistics here. Now, also during that time, as I mentioned, our current conditions occurred 24 times. Of those 24 times, 70.8% of the bars were similarly favorable for selling that out of the money put premium. Now, that implies a selling edge of minus 12.1%. Remember, the benchmark is at 82.9. Okay, of these 24 incidences, just 70.8% of them turned out to be okay, meaning that almost 30% of those resulted in the market coming down that full standard deviation and hitting that strike price, a standard deviation away. So statistically then, it's more likely than usual that Friday's bar will end up being one that is unfavorable for selling out of the money put premium, standard deviation away 1 month out. All right, so that's the bull put spread timing report. It doesn't look as favorable as other market conditions, clearly. Now, finally, our market likelihood report answers the question based upon our current market condition and the past behavior of the market when it's been in a similar condition. What is the market likely to do? Go up, down, or wobble around? You know, in the middle and not really do much. What's it likely to do based upon past examples of our current market condition? So to answer this, we have to look at price distribution. And what we have here are 6 numbers, 3 of them highlighted in the green column, 3 of them highlighted in the pink, as you can see. Okay, and what we do there is we look at volatility bands and the percentage of times that the market strikes our volatility bands. We set these bands out 5, 10, and 15 days, 1 standard deviation, 3 to the upside, and then 3 bands to the downside, starting from the close. Now, the bands to the upside are closer to the close than the bands to the downside. And let me show you an example of this. Okay, let me click here, escape. There we go. And let me show you an example. Here we go. All right, so here we have the close. Okay, and here we have a volatility band. These are 5-day bands. These are set 1 standard deviation away, 5 days out. And so here you have a 5-day band up here to the upside and a 5-day band to the downside. Now note that the upside band is closer to the close than the downside band, and that's because we are looking at this from the perspective of a SIBO skew adjusted VIX number coming from the option prices themselves. The market is telling us how far to set these distribution bands. And the out-of-the-money call options to the upside, the out-of-the-money calls have a lower implied volatility typically than the out-of-the-money puts to the downside. That's why on the upside it's closer to the close than on the downside. See that? And so the question then here is whether the market goes up and in 5 days strikes that upper band, strikes the lower band, or fails to strike either one. And we're going to go back over 4,400 closes and look at those statistics to get our benchmark. So again, as I said, we look at this from the perspective, oops, time out. Let's click here. We look at 5, and these are the 10 in blue, and then we look at the 15-day bands as well, and we take statistics on all 6 of those. the upper 5-day band over the course of 4,446 occurrences, the 5-day band to the upside is struck 21.5% of the time. The upper 10-day band, 15.9. The upper 15, 14.8. The lower bands are struck 16.7, 16.9, and 19.7 on that lower 15-day band. So this is the benchmark. These are the benchmark figures. Now, we must have had an extra occurrence when this was calculated. Take a look at this, though. The lower bands are all struck more often than the benchmark. Look at that. All struck more often. Those are in blue. Do you see that? Over here, the upper bands are struck typically less often. Oh, this one's about a wash. Less often. Okay? And then down here we have, and so this is from the close. Of those occurrences, of those 25, there are 16 occurrences where the market went above that inside bar's high. Now, of those 16 occurrences where that happened, the upside bands all were struck less often, and the downside bands were struck more often. So this is speaking to a bearish likelihood. It's not a guarantee, because those upside bands have been struck, clearly. But the downside bands across the board have been struck more often than the benchmark. So if you're going to lean a direction, you would want to lean this to the bearish side based upon these 25 occurrences. All right, so that's the likelihood report as we have it from Friday. Okay, thanks so much for joining us. I'm Steve Lentz with Discover Options. Have a great week trading. We'll talk to you next week. Bye-bye.